Welcome to the report for the 23rd of February, 2024. Time really passes. I don't know with you guys, but man, it's like I just celebrated the New Year, English New Year, then the Chinese New Year, and then now we are at the end of February. Wow, amazing how time passes. So let's kick off with the news events for today. And today I'd like to talk about the FOMC meeting minutes update. I think it's crucial for everybody to understand what has transpired during the meeting, and a more detailed version is explained in the minutes. Now, the recent minutes from the Fed, right, reveal a cautious stance on monetary policy, highlighting that the rate reduction will not be considered. Now, this is the key point over here. Will not be considered is that until there's a substantial assurance that inflation is on a downwards trajectory. Now, if you remember, last last month we had an increase in inflation, although we do not expect this to last, right? These are those things that the Fed will be looking at and saying that hold on, we have to be careful not to be too trigger happy and look into rates cutting that fast, right? So the Fed expressed reluctance to initiate rate cuts prematurely, fearing the need for reversal, such as slowing the pace of cuts, or more critically, resorting to rate increases again. This is something that will show that whoever is managing the Fed, right, like Powell and stuff, they are incompetent, and this is what they don't want. That's why sometimes you do see that they are always very slow in raising the rates, and they're always very slow in cutting the rates, just to be sure. The key point here for them is just to be sure. So the summary of the meeting minutes conveyed a cautious, optimistic view that the Fed's policy adjustments have been effective in mitigating inflation, suggesting that the era of rate hikes may have concluded. Okay, so that's one thing for sure. We won't see, probably won't see any rate hikes anymore. However, the Fed also acknowledged that ongoing challenges of determining the duration for maintaining a restrictive monetary stance, particularly in light of persistent inflation, adversely affecting household. They understand that it's bad for the household, especially those less financially equipped to cope with rising costs. We have also seen the delinquency rate, the loan delinquency rate for credit cards as well as other loans for the consumers has been on the rise, right? And that is not a good thing at all. So the recent economic indicators have surpassed expectation, however, and that's one of the causes where it is unsettling the previous observed deceleration in inflation and affirming the Fed's prudent approach. Okay, because everything is so good. We have seen stuff like this. Notably, if you see the US economy expanded at 2.5% annual rate in 2023, and the backdrop of the increasing rates, and then you have preliminary data for the first quarter indicating a potential increase to 2.9% GDP. Now, if you add in the 353,000 non-farm job payrolls, that further supports the view that the Fed rate hikes have not significantly impeded economic growth. Okay, for now. Later, we don't know, but for now. So this is one of the reasons is that, wow, it's still growing. Economy is good. Probably we will have a soft landing. And there's no point of cutting rates right at the moment. Yes, the loan delinquency going up, but it's still manageable. People have jobs they can pay, right? So the Fed's primary objective remains to temper inflation pressures without prematurely easing monetary conditions, which could potentially rekindle inflation. That's what they don't want. And market participants anticipate 3 to 4 rate cuts in 2024, probably to 3, with expectations of coalescing around a potential initial rate cut in June 2024, currently estimated at 70% likelihood. Okay, so if there's any rate cuts, probably will be at 70%. Now, at their upcoming March meeting, the Fed officials are expected to provide updates forecasts for interest rates and the economic outlook. So this is a very important meeting, like the one we had in December when you had the dot plots and stuff like that. Okay, so that is crucial. And additionally, the minutes suggest some Fed officials are considering a slowdown in the pace of Fed's balance sheet reduction, known as quantitative tightening. Now, this is a very important thing. Now, about the rates, now mind, we don't know when they want to cut, they cut, but we see that's June. But if they start the QT, this is a beginning of a new thing, because what this means as when they start QT, right? Cutting QT, the amount QT, in a way you are releasing liquidity. That's why I said the adjustment would decrease the volume treasuries the market must absorb, thereby alleviating liquidity pressures. This is very, very crucial. Liquidity here drives market higher. Okay. So I think the whole world is waiting for that. And when they start again, the QE, not the QT, quantitative easing, that's when you would see the market start pushing even higher. And that's why it's crucial for everyone to see what could happen next when it comes to this area in the next meeting. It's very, very important. If you see this, it is very good news. So while a comprehensive discussion on this topic is slated for March meeting, it's clear that a complete halt, don't expect it to cut straight away everything. Halt, that's unlikely, as several Fed participants believe it should continue even after the rate reduction commence. Okay, so this is something very, very crucial, and that's why when this news came up, you did see slowly the US market started moving even higher, because this kind of news are really good news. They're showing that overall economy is still good. Okay, they can handle this, and that's why things are what they are. Okay, so that's the end of the fundamental report for today. Let's move on to the charts.